about how you went to college, and, you know, your dad was the executive vice president, and how you got this job, and you were a history major. It's like, we don't want to hear that. We want to hear you tell us about the training program, the licensing, the internships, and the jobs, okay? And then after you've talked for 20 minutes, we want you to sit down with people who have actually come with their resumes, and we want you to do 5-minute interviews with them and walk out with a stack of resumes of people that you're considering hiring. We're going to do that with Merrill Lynch, maybe JP Morgan. We're going to do it with Cushman Wakefield, CV Richard Ellis, Jones Lang LaSalle, and if you want us to get Salesforce or BlackRock or something like that, you tell us, and we'll try to bring them in every Wednesday between 1 and 2. Okay, and just like hire, and see if we can place like 100 students.
Wow.
Yeah, in internship. Now my goal is 50 a semester, if I can do it. It's a little aggressive, but you got to shoot big. Okay. So I think those are most of the announcements. Was anybody interested? Any finance majors? Finance majors? Okay, finance. So you guys need to quickly the CFA challenge. Okay, put your name, your email address, and your phone number. I'm starting to take resumes or applications at the CFA challenge. I'm going to put together a team of 5 core individuals with 2 alternates. Okay, and then we'll train you on the securities valuation piece of it. Maybe you'll get picked up for the investment group. Okay. And then at the finance club events, there's going to be a bunch of finance people there that you can talk to that I'll say, hey, you got to go talk to that person right there and give them your business card. Okay. So start thinking about, you should be looking for your jobs right now. Okay. Because once October hits, what's at the end of October? What's October 30th? Halloween, and everybody loves to dress up their kids, right? Feed them with sugar, so they're not going to be thinking about hiring you. And then what happens the 3rd week of November? You got Thanksgiving. You think they're going to be hiring you during Thanksgiving? No, and then you come back and you're gone. So you only have, what, maybe 3-4 weeks to get your job for next semester?
Can you
want to, or next summer? So you got to be really thinking about the hiring cycle. Okay, and now's the best time to be looking right now.
Can you get someone from Workday as well?
Write me down the list and we'll see if I can bring them in.
Okay.
How do you think I can get people from Workday to come in and do hiring? What do you think it takes?
It's really hard to get in.
Yeah, how do I do it?
Email. Networking?
No. What would I do?
LinkedIn?
Pick up the phone. Dial the phone. Hello, Workday. Hey, I got some students here that are really motivated, already pre-selected. A lot of them, we've got their resumes all done. Bring them in, come tell us about your hiring program with internships and jobs. And then what we'll do is we'll have at least 15 students there that you can meet with for 3 to 4 minutes, and you can take a stack of resumes on the way out. Okay? It's not rocket science, it's basic marketing is what it is. It's just sales. All right, so let's do this. Any questions on the pretest? Everybody know what multilinearity is and how to get rid of it? And build the model like a two variables in the regression model. They're highly correlated to each other and also correlated to the dependent variable. I don't need both of them, I only need one. How do I decide which one to keep and which one to throw out? This is right on your exam, so you should be writing this down. Right? These are the questions on the exam. Professor Souza, what am I going to do? I can't answer some of the questions because I don't know the questions. Well, you wouldn't know the questions because you don't have 15 years, of experience running research departments. So Professor Souza, what do I do? Should I just try to answer it or should I skip over it, and then bring the answers to class and ask me the questions? So how do you solve for multicollinearity? How do you choose which one to keep and which one to throw out? Did I already go over this in class? I think I did. How do you do it? And build the model. I got 2 variables in the model that are highly correlated to each other and also correlated to for the dependent variable. I gotta throw one out, and I gotta keep the other. How do I make that decision?
You pick the most frequently cited variable. Right?
In what? Where is it cited? On, Breitbart News or Berkeley Barb or something, or where's it cited? Have you guys ever done any research? You ever written a paper? Have you ever written a research paper? Have you ever written a research paper? Okay. So what do you do when you write a research paper? What do you do? Yeah, got it. So basically what you do is you keep the variable that's been cited the most in what type of journals? What? Academic peer-reviewed journal articles. Okay. So the variable that's been cited the most in the peer-reviewed journal articles basically makes up the literature that makes up the theory. Okay. Around the model and around the variables. Okay, got it. That's also called external validation, external validity. You're going to be in front of a senior executive team. They will have asked you to go build a model. They're going to say, how did you build the model? And you're going to go, I don't know, I don't remember. Tony basically told me to put some variables in the model. No, that's not the way it is. You went to the library, you looked up all the academic research, based on how to build a, let's say, return on equity forecast model. You read all of the literature. You noticed that in half a dozen of the dozen articles, they keep referring to 3 or 4 variables that keep coming up over and over again over time. That's basically the literature that sets the theory in which you build the model, in which you use the independent variables. Okay? So in the meeting, you're going to have to cite off the top of your head what the journals were, who the authors were, when it was published, what the data was, and basically defend yourself. And that your model is valid and is actually going to do what you think it's going to do. Okay? What's external validity? It's a test question I just answered the question like 2 seconds ago. I would be writing this stuff down. So what's external validity? Cortland, let's do it again.
I put the causal relationship between cause and effect.
Okay, but external validity isn't it basically going to the peer-reviewed journal articles and basically using those citations and using the literature as the theory to back up your forecast model? Exactly. So that's external validation. What's internal validity? Do you think that you'll be able to build a model that nobody buys off on? That the person in the front row is saying, I don't agree with you. The chairman of the board, the senior executive, the managing director of data analytics is saying, Larry, I don't believe in your model. I think your data set's flawed, and I think the variables in your model are incorrect. Are you going to be able to defend yourself if you don't get internal buy-off on your model? Can you move forward with people in your firm not accepting or buying off on your model and your methodology? So you need internal validation. The best way that you do it is you co-opt them into the research process and you ask them, what model structure should we be using and what variables do you think drive return on equity? Now you've totally co-opted them and you're basically relying on their expertise and experience to help guide you to get the internal validation you need, to be able to build a model, to get the results, to back test it, to forward test it, and make the policy recommendations to the senior level executive team. Okay. Again, that's not in your books. Okay. You would only do that if you had done it before. Okay. I think those are it, other than cross-sectional regression, which is basically one time period across multiple firms in the same sector, and you're running the regression, with the variables that are highly predictive for the dependent variable. Time series, it's one company, same variables, but the variables over time. Okay. I got to get you to start thinking in regression and modeling and back testing and forward testing and policy recommendations, because this is what you're going to be doing. You went to St. Mary's, you got a Bachelor of Science in Business Administration with a concentration in X. You're walking out with a certain level of expertise within your concentration or within your discipline, and they're gonna be asking you questions, and you're gonna have to answer the questions based on the knowledge that you've learned, or the experience that you've acquired, okay? And if you don't know it, you better tell them you don't know it, okay? Because if you lie, you're trying to make stuff up, you're fired. Okay, so let's go through the, any questions on the pre-test, is that it? Resource, plenty of resources up there, Investopedia, you can use Google, you can use your find investments books, stat books, there's plenty of resources out there. It's just those multicollinearity seems to be the hardest one because you just don't have 15 years of experience. Okay, any questions? Okay, we're gonna do the exam. So the first question that I would do is pull out the exam and pull out your blue book. Does everybody have an exam? Did everybody bring their blue book?
Pencil or pen, doesn't matter?
It doesn't matter. You can blow through the blue book, write the notes, and then go to binder paper, and then just fold it up and stick it in the blue book when you sit it. Okay? I use the blue book because it basically fits with the exam. They look the same, and I've got a system. The deliverables put in a certain order so that I can review like 9 of them. Because I got 3 classes. So 90 students. I got everything, if it's uniform, I can check it all off, I can give feedback, and then, you know, you get feedback and not just some stupid grade, you know, based on how you felt, you know, that day when you took the exam. Okay, tell me when you're ready. We already did a lot of the stuff in the last class, so you guys will probably get further ahead than the last class. Okay. So you're gonna have to take pictures of this. I'll go through it slowly. Please write the notes down because they'll follow the exam. Okay. No joke on the exam. Okay. It's exactly the same. Okay. No surprises. It's hard enough as it is. All right. But I'm making you do the hard stuff right now. Okay, so instead of on the midterm and the final.
So we're just gonna follow straight down the page.
I'm going straight through it.
Okay.
Okay. And then use a blue book. Here's a bunch of blue books if you need some extra blue books. Start with the blue books, and if you blow through the blue book, then you can write it on binder paper, or you can just take another blue book. Okay. So there's a method to my madness. Okay, so tell me when you're ready.
Red.
Ready, okay. So when building a forecast model, what are the first questions that need to be taken? So, I'm sorry, what was your name again?
Jake.
Jake?
Yeah.
Jake, I need you to, I'm your managing director, I come in. Jake, I need you to build a return on equity forecast model. What's the first thing that comes out of your mouth?
Yes, okay.
Perfect, exactly, yes. Okay, if you say no, they'll find somebody else,
Be on your desk tomorrow at 12.
pretty much. So the first answer is yes, okay? What's the series of questions that you're gonna ask me?
Wait,
What? What'd you say?
you said yes was the first answer? It says
Yeah,
what are the
hey,
first-
will you build me a forecast model? Jake?
Yes.
Yes, okay. Now, Jake, you're gonna ask me a few questions, right?
Mm-hmm.
Have you ever built a return on equity forecast
I
model
have
before?
not.
So what
I'm
are you
about
gonna-
to,
So what are you gonna ask me? What are the series of questions? This is gonna happen to you, so might as well get it out of the way right now.
What are the first steps that need to be taken? Is that what
Yeah.
you're looking for?
Yeah, so
Oh,
you're gonna start asking me questions, because basically you're like a consultant,
Yeah.
internal consultant. So what are the things you need to know to be able to build this model? You've been tasked with building a return on equity forecast model. Well, Jake, will you build me the model?
Yes.
Yes. Now what do you start asking me?
Well, now do I act like I don't know it? Or do
No,
I?
you just ask me like smart questions,
Oh, okay.
right? Because I know how to do it,
Yeah.
right? I just don't have time to do it, right? So what are the first 3 questions you would ask me? You guys can just yell it out. What?
What time period you need it for?
Yeah, when do you need it? Right? So I know what the milestone date is, so I know how much it's gonna cost and what resources I'm gonna need, right? Because if he says tomorrow, it's not enough time to get the data unless I buy the data. I don't have enough man or woman power to be able to crank it out, so I'm gonna have to work in a team. So when do I need it?
What data? Or,
Uh,
What are we forecasting?
Return on equity, I already told you,
Oh,
okay? When do you need it?
What
What else?
software do you want us to use?
Do you have any recommended software applications, internally? That would be pretty good, but not high up on the list. Come on, you're the consultants. You're all business majors, you've been through all of this. What are the questions? When do you need it?
how much are you getting paid?
What?
How much are you paying?
Yeah, how much is it gonna cost?
Yeah, how much is it?
Right, do you have a budget,
yeah.
right? I mean, if it's gonna cost me $100,000 to buy the data, right? And then, it's an 8-month project and I gotta hire programmers and data analysts, that's gonna cost me, that's a $600,000 project. Right there over an 8-9 month period, right? So I need to know the time, I need to know if you got a budget. What else do you need to know? Are you gonna do it yourself?
No.
Probably not.
Probably have a team.
So are you gonna ask, who am I gonna be working with?
Who am I working?
Yeah. Am I gonna be working with anybody, or do I have to do it myself? So you gotta know who your team is, what resources you have available to you. And then what's another really important question? Jake, you've never built one of these models before, right?
No.
So what question do you wanna ask me?
What?
What?
Can you help me?
Give me something more specific, like a consultant.
What is a
How do you
forecast
make a
model?
forecasting model?
What?
What is a forecast model?
Have you,
It's not quite that low.
what?
An example of them?
Yeah, example, have you done it before? Obviously I have. What model did you use when you were forecasting return on equity? What's the second question after that? Not only what model, but what? What? It's a model.
Yeah.
The dependent variable is return on equity. If I'm gonna forecast return on equity, what do I need to know?
How long?
No. What do I need to forecast the return on equity?
Sales or increasing
Okay, you're getting there, what are those called?
net sales?
Yeah, but what are those called? If net sales is highly correlated to the dependent variable of return on equity, what is net sales called?
Assets?
No, what's it called in a model? Say it,
Independent.
the independent variables. What variables do you think drive return on equity? I'm the expert, I've been doing it for 15, 20 years, I've built these models, I don't have time to build the model, I need you to build the model. But I don't know how to build the model, but I'll tell you how to build the model and I'll set you up with people who know how to build the model. The most important question is you flip it around and you go, what variables do you think should be in the model? Based on your experience and your academic training, what variables do you think should be in the model? And then who else do you go ask those questions to? Who?
Your team?
I'll ask my team, but I'll also ask, do you think senior level executives in the firm would know?
Yeah.
Yeah. Do you think that senior level executives or other people outside of the firm, if it's not, proprietary, that I could ask other experts who have built these types of models before, what variables they think should be in the model?
So that's how you would determine it?
Yeah.
So you should ask for proprietary first.
Yeah. Yeah, it's the fastest way to get to it. You turn it right back around. What variables do you think should be in the model? And then you go survey senior executives in the company, and you say, I've been tasked to build a return on equity forecast model. What variables do you think should be in the model? Do you think there's going to be overlap? Do you think that if I survey 12 executives, that of the 12, there's going to be similar variables that are mentioned, be based on experience? Yes. And then where else are you going to go to verify and validate the independent variables? Where else are you going to go? First, you ask the internal people who have expertise, then you're going to go where?
Internal.
External
Go where?
sources.
Survey?
I'm not going to do a survey. I could, but where am I going to go get the what?
Database.
Online.
Databases, online, peer-reviewed journal articles, academic and industry research reports based on the literature that's going to build the theory on what has worked historically in the past in forecasting return on equity. Now, this is all model building. Okay? It doesn't matter that it was return on equity. It's the process. Okay? and you're gonna be doing this stuff, okay? Or they're gonna ask you to do it, and if you say no, you're gonna be not as valuable. If you say yes, but I don't know how to do it, how would you do it, and what do you think should be in the model? You're now an internal consultant, okay? And you're gonna be able to figure it out, because it's not rocket science. Okay. How do you determine the dependent and independent variables? What drives value for a stock?
External events?
Economic factors,
Yeah.
right? So if I'm trying to forecast return on equity, that's one. I could be forecasting revenues or sales. I could be forecasting returns on the stock. Those are all dependent variables that consultants and internal people within that sector and in that business would know. Okay? Profitability, profit margins. Those are all factors that we want to know. Production, sales forecasts. Those are all things that we want to be able to model and we want to be able to forecast. How do you determine the independent variables? Let's do it again. So the dependent variables are basically determined by best practices within the industry and within business. How do you determine the independent variables? Hey dude, what's up, man? I'm doing a forecast model on ROE. Do you know what the independent variables are? No, I don't know. Yeah, I don't know either. Now, how do you do it? How do you figure out the independent variables? I just spent the last 5 minutes going over it. How do you figure out the independent variables?
Is that your external and internal, like?
Yeah, you're
questions you
gonna
ask?
talk to people internally within the
Yeah.
firm, and you're gonna be able to do external research to basically figure out what the variables are, and then you're gonna test the variables using regression techniques, and then you're gonna back test it, forward test it, and if it works, you're gonna be able to make policy recommendations to senior level executives, and if it actually works, and you actually make money or mitigate risk or mitigate loss, you're gonna get promoted. Okay? Yep.
So to sum it up, you basically say yes and ask a lot of questions.
You got it. That's right. You ask a lot of questions until you basically exhausted
And
all of the questions. And then you go do it again with others.
so
And then you put together a report. Okay.
So independent is external, internal, and then.
Yeah, independent variables can be determined by internal people within the company through survey approach. Independent variables can also be identified through industry research and peer-reviewed journal articles.
So as far as an exam goes, like any of these answers work?
Huh?
Do I-
Well, I'm expecting you to write these, yeah,
That's what I was
I'm
wondering. 'cause
expecting
I-
you to write these down.
I know that, but I'm
Yeah,
just
and then study
wondering,
from
like, how many examples of them would you want?
it, as many as you can.
Okay.
How much can you remember?
No, that makes sense.
If it's blank, then you didn't study.
Well, no, it was like,
Right.
for like an independent example, it'd be like, for independent, it'd be like,
Peer-reviewed
internal
journal
independent.
articles, interviewing senior
yeah,
level
that's what I had written
executives.
down, what that was.
You know, the person that asked you to build the model. You know, what I'm trying to do is to teach you 15 years of experience, you know, within like 10, 15 minutes, right? Because you're not gonna get it from your statistics class, right? They're not gonna teach you how to do it. You only learn this stuff if you run a business internal and worked at the tactical level between the strategy level of the company and the operations level of the company. You would only know this based on experience. So I'm trying to give you, fast track you to give you the experience that you need to have these conversations with people in your internships or in your jobs, okay? It's just, let's get through it really quickly so I can train you.
can you go over the dependent variable one more time?
Yeah, so the dependent variables are gonna be determined based on the standards of the industry. So we know if I'm working on the finance side of the business, maybe not the operations or the production side or the marketing side, but I'm on the finance side, I'm gonna wanna be able to forecast return on assets, return on equity, or return on our stock prices are the main dependent variables. And if you go work at Cisco in production for semiconductors, you know, they're gonna wanna know how to forecast production levels, you know, out of Southeast Asia based on DRAM chips, right? So that's gonna be production forecast using the same model methodology. Finance has its own dependent and independent variables. Marketing has its own. You know, data science has its own. So depends on where you are, what industry, what type of company, what department you're in is gonna determine the dependent variables that you're trying to forecast. And there's gonna be a ton of people around you with lots of experience that are gonna guide you. Okay? They just don't have time to do it, so we're gonna have you do it. And do the best you can. Just tell me how you're doing tomorrow, okay, or in 2 days. All right, so, go ahead.
Oh, I said thank you.
Okay, you're welcome. How would you test for variable and model significance? So using regression, and this is all on the off the pre-test. So what is the statistical test that you would test for the independent variables, statistical significance in predicting the dependent variable?
How many variables are we supposed to have? I'm confused. Did we skip a question?
Did we?
Yeah. We skipped how many variables should be in your model.
Okay, how many? What's the max?
As many as,
You need
No,
3?
no, because if you have too many variables in the model, what problem do you run into?
Too much data.
What's it called? What's it called?
You just ask what are the variables.
If you have too many variables in the model, what problem do you have? Multicollinearity. So, based on the rule of model building, what's the maximum number of variables you should have in the model? No more than 5. Okay? And even with 5, you probably are going to run into multicollinearity. Okay. How do you test for variable and model significance? It was in the pre-test. If you read the pre-test, it says, what are the tests of model significance? So I run a regression, I got some independent variables. How do I know that the independent variables are statistically significant? What am I looking at? What test? I'm using a regression. I run the regression on the independent variables, and I'm going to look at what? What? The t-test. The t-test. So the t-test is going to test the statistical significance of the independent variable's ability to predict the dependent variable. Got it. Awesome. What about the model? What test do we use to test the model's ability to predict the dependent variable?
so the t-test was for the variable.
The independent variable's ability to predict the dependent variable. So the t-test is a single variable test. Okay? So it's at the variable level. Okay, and what is the, if I build a model, what test do I use to test the statistical significance of the model's ability to predict the dependent variable? No, that's a, student T is irrelevant. We don't use that. What's the other one? It's on there. It's right there. If you read it, it's right there. What is it? F test.
What was it?
F. F stat. F statistic. The F test is basically is a measure of the statistical significance of the model itself. The combination of independent variables' ability to predict the dependent variable. Anybody data analytics in here? Anybody marketing in here? Okay. You guys will probably be using regression. Okay. Data analytics, finance, accounting, ops, we all use regression. Okay. You can also use the adjusted R-square. Okay. R-square, the adjusted R-square, also basically tests for the model's correlation with the dependent variable. Okay, that's another measure, but the F is the test, and the T. Excellent. If you are experiencing multicollinearity in your model, and if you have two variables that are highly correlated to the dependent variable and correlated to themselves, how would you decide which one to keep and which one to throw out?
Which one shows up more in your reviewed sources?
Exactly. It's the ones that basically have been cited the most in the literature. That basically has formed the theory behind the model. Okay, excellent, nice job. Were you taking notes or did you just know that?
Just remembered it from
Yep.
like 5 minutes ago.
Perfect. No, I'm telling you, I tell you the answers and just goes in one hair and out the other. But I usually give you the answers before I actually ask the questions to see if you are listening and writing notes.
A lot of stuff.
Yeah, it is a lot of stuff. It is a lot of stuff. But again, I will have advanced you by years or months within your career from this stuff, okay? Because this took me a long time to figure
I was
out.
gonna say, I also see why the test takes many days to finish.
Huh?
I see why the test takes a couple days to finish.
Yeah, it takes 2 days.
Yeah.
And you basically study, you review. I do review sessions too. Most people, I would say, 3/4 of the class does fine. Okay, the others just didn't admit it, they just didn't study. Okay. And then I make them do it, go study and come back and take the test. Okay. Nobody fails my class. What is internal and external validity and how do you achieve it? What's internal validity? Did you write it
From
down?
outside.
What? That's external.
Oh, I thought you said external.
Let's just do external. What's external validity?
When you get it from outside source.
Yeah, you get it from peer-reviewed journal articles based on the literature that becomes the theory behind the model. So that's external validation. Actually, external validation can also be conducted through surveys, where basically you talk to experts outside of your firm, but you gotta make sure that it's non-proprietary. And you ask them, I'm building a regression forecast model to predict return on equity. I know you've done it before in the past. What variables did you have in your model and how did they work? So you just ask other experts. And then internal validation,
Discussing within your firm.
discussing with other experts within the firm that have done it before in the past. Okay. So you're trying to get buy-off, not only internally amongst the staff, but you're trying to get buy-off from experts within the firm that are at the senior executive level. If any one of the senior level executives on the investment committee, board of directors, or senior level management start questioning the validity of your model and the results of your back and your forward tests, you're gonna have to defend yourself. And you're gonna have to start citing the people that you talked to, the research journals that you read, the journals that they were in, the results that they were in, you're gonna have to start defending yourself.
So, when you do the internal, so when you're working with executives and then you give it to the higher executives?
You're talking to people in the firm.
Yeah.
So I'm building an ROE model, return on equity. I've talked to some people who have built the models internally before. I've talked to some people outside the firm that have built the models before. I've searched the industry and the academic literature, to basically validate the variables in the model that I'm using. And I wanted to run it by you to see what you think.
So in real life, you would be citing your sources that.
Yeah, I talked to Bob, Carol, John, who basically have built models before in the past. They looked at the model, they agreed with the variables, they agreed with the model structure. They looked at the results of the regression, they looked at the back tests and the forward tests, and they all agree that the results were valid. So I went ahead and did the forecast, and here's my recommendation. And this is what I think the company should do. Okay, that's how it works.
So technically, could you ask the execs yourself?
Yeah.
To validate beforehand or account?
Yeah, take a look at it, tell me what you think. And then I'm gonna go ahead and do it, I'll collect the
So
data,
that would be an example.
I'll back
of
test,
internal
forward
validation.
test, I'll show you the results, you tell me what you think, and then I'll go ahead and finish off the model, make the projections, put together the PowerPoint presentation and the report. I'll submit it a week before the meeting, then we'll go into the meeting, I'll do the presentation, and you guys can ask me questions.
So typically, it seems like external would come first then, right? Then you do your
Yeah.
internal?
Yeah, but I would ask people probably first to get them co-opted
Oh.
and bought off very quickly within the process, okay? Because you need to have buy-off, okay? Or else if you're fighting against somebody or a group of individuals, you ain't going very far, okay? So you want to co-opt them as fast as possible, all right? Does that answer that stuff? Okay. All right, so the next question is unorthodox monetary policy and quantitative easing and negative interest rate. Now, why are we studying this stuff? Why are we studying monetary policy and unorthodox monetary policy? Why would we do that? That's crazy, right? Do we care? If the Federal Reserve starts dumping bonds and collapses bond prices and drives interest rates up too fast, too far, are we going into a recession? Yep. Do you care about that?
Yeah.
Do you care that the financial crisis was the biggest financial crisis and the most severe recession post-World War II? And was not analogous to the Great Depression, but came pretty darn close? Do we care about that?
Yeah.
Yeah, because if we came pretty close to it last time, what does that tell you about the future? Could it happen again? Yep, could happen again. Do we care as managers? Yep, yep. So you need to understand this stuff, because this is the stuff we're talking about around the table with the senior level executives. Okay? What is the Fed doing? What are interest rates doing? What are the yield curve doing? How big is the balance sheet? Are they gonna unwind the balance sheet? What's the capacity of the Fed's balance sheet to basically bail us out of the next financial crisis? Or did they run out of money and we don't have any money left? Is there gonna be fiscal policy to basically bail us out and stimulate the economy and get us out of the Great Recession next time? Or have we reached our fiscal policy maximization? There's no more money left, in monetarily or fiscally, to get us out of the next Great Recession. Do we care about that as managers? And we want to have jobs too, to immunize ourselves from the next recession, okay? Because I've been fired every recession, because my business is cyclical. I'm a real estate economist. It goes up and down with the business cycle. Every time we go into a recession, I get fired, okay? That's just the way it is, okay? So you have to ask yourself, you gotta be thinking about this stuff. So here's the test question. What is the size of the Federal Reserve's balance sheet? And how much money by banks are being held on reserve at the Federal Reserve? Now, I looked it up, and you want to write these notes down. And the question is, what do we care? Why do we care about this stuff? Well, in 2019, just recently, the size of the Fed's balance sheet and the reserves that are being held on the Fed's balance sheet is around 3.7 trillion. Okay, is that a lot of money?
That was 2017?
That was at 2019.
Oh, 2019. Is that the size? Or
That's the size of the Fed's balance sheet and the amount of reserves. They're really close. It's an identity. The reserves are liabilities, and the assets are the treasury securities that they're holding. So they're really close to each other. Okay. And this exercise is not based on nuanced, perfect numbers nuance, but relative scale. So currently, the size of the Fed's balance sheet, the assets and the liabilities, the reserves, is 3.7 trillion. Okay? It got as high as 5.3 trillion, okay, in 2010 through 15. So right in the worst part of the financial crisis. So the Fed basically printed all this money out of the air, okay, and then started buying U.S. government treasury securities, as the federal government was basically racking up fiscal deficits. So basically the government would rack up $1 trillion in budget deficit, and the Federal Reserve would print $1 trillion, take those treasury securities and stick them on the Fed's balance sheet. So money out of thin air. Okay? Never been done before in the history of monetary policy, going back 500 years, or even going back 150 years. So never been done before. This is the 300-pound gorilla in the room. And nobody knows what the outcomes are going to be. So it peaked out at 5.3. They unwound the balance sheet over the last 4 years, selling off the treasury securities and bringing down the balance sheet so that they could rack up the balance sheet again when we fall into the next recession. Okay, so that's what they were trying to do. The balance sheet, if you go back in history, the reserves and the assets on the balance sheet between 1970 in 2007, right before the financial crisis, was between 250 and 800 billion, so an average of 500 billion. 5 trillion, 500 billion, okay? Big difference, right? Yes.
And that's the amount being held on reserve?
Yeah, so this is the size of the Fed's balance sheet. Okay, so the Fed, what it would do is it would hold an inventory of treasury securities of around this much. That basically would use that inventory of treasury securities to buy and sell government bonds in the open markets to either drive up bond prices and drive down interest rates to stimulate the economy, Or it would take that inventory and sell off the inventory, drive down bond prices, drive up interest rates to cool the economy, to keep it from overheating. Okay? But this is way beyond an inventory of treasury securities. This is basically manufactured funds out of thin air, okay? To basically bail out the system, to basically buy a lot of the defective products that were sitting on the bank's balance sheets, to basically print money, scrape all that crap off of the bank's balance sheets, and basically put it on the Fed's balance sheet and have the Fed work it out. So we recapitalize the banking system to keep the banks from going insolvent, to keep from the runs on the bank, to keep us from going into a depression. Okay? It was pretty brilliant. It was very quick in what they did, and nobody really knew exactly what they were doing, except for Wall Street and monetary and macroeconomic economists were tracking. Yeah.
So the size of the Federal Reserve's balance sheet is 3.7
Currently,
trillion.
the peak was 5.3, and between 1970 and 2007, it averaged around 500 billion.
So the growth would be just subtracting 500 billion from 3.7 trillion? I have a
Yeah.
question there, it says.
Yeah,
what
so
is
how many
10
times is that? That's what, like 10 times? Or 100 times? 100 times to go from 500 billion to 5 trillion? That's never been done before. And not only was it done, here in the United States, but it was done across the globe. Okay.
Wait,
So they printed about 35 to 40 trillion dollars on a global basis, all coordinated by all of the central banks.
but just of US currency?
Just the US is 5.3 trillion. So
You
there's
said
about
it-
30 trillion on a global basis that was printed. We printed about 5.
So who else printed a lot? Do you have any idea?
The European Central Bank, the Bank of Japan, the Chinese Central Bank, the Brazilian Central Bank, the South African Central Bank, all the central banks.
Why did they do it? if
They
you
printed
said-
money to buy US government, or to buy government securities, corporate bonds, to drive up bond prices, to drive down interest rates, to stimulate the economy by lowering the cost of capital. Never been done before. Okay? Never been done. That's why this is important to understand. So the size of the Fed's balance sheet is the same as the reserves on the Federal, held on the Federal Reserve. So they're both 3.7 trillion. So the reserves and the size are the same. One's a liability, the other's an asset. Okay? What was it prior to 2007? On average, 500 billion, but ranged from 250 to 800. Okay? What has been the growth of the money supply since 2007?
100 times.
Huh?
You said 100 times, right?
No, growth of the money supply.
Oh.
So the money supply in 2008 and 2009 was 30 to 40%. So they were just printing money, increasing the money supply, drive down interest rates, to try to stimulate the economy and keep the economy from going into a depression. Okay? And that's really high, because the money supply growth rates right now are averaging between 5 and 8%. And they were growing the money supply at 30 to 40% in the deepest, darkest part of the recession, or the Great Recession. Okay? And I'll go through this in a second, this equation. Has the Fed hit gross domestic product, employment or unemployment, and inflation targets, such as the consumer price index? The answer is yes, and the answer is no. Okay. The real answer is, over the long run, over the last 10 years, the answer's been no. Okay. But recently, the answer is yes.
Is
Okay,
that
I'll go
for-
through that in a second.
Is that for all three or just for GDP?
For all three. Okay, I'll go through it in a second. I have the indicators up here, and I'll walk you through them slowly. And then lastly, if we were to fall into a recession, would the Fed use negative interest rate policy? The answer is yes. And then I'll give you in a second what the impact in the short run and the long run would be on the economy, asset prices, savers, investors, and businesses. Okay. This all relates, because I've been talking about this stuff for 8 years now, 5 years here at St. Mary's, and now I'm getting calls from my students asking me questions like, now that the yield curve is inverted, are we going into a recession? I've been talking about that for 5 years. It's just now coming due. Okay? It's now relevant. So let's go through it. So has the Federal Reserve hit its gross domestic unemployment and inflation targets? The answer is yes and no. So here's the equation. Okay, you want to write this equation down. This is the equation right here. And I'll walk you through it really quickly. The equation is called the quantity theory of money, or QTM. It's called the theory of exchange, and it was invented by Irving Fisher. Okay? Because I was racking my brain for 5 years, in 2009, 10, 11, 12, and 13. I couldn't figure out why the Fed was printing so much money and it had no effect on GDP or inflation, in which they were trying to target. Okay? So there's something wrong, there's something not working. And then one day, I woke up in the morning and I saw the quantity theory of money equation in my brain from my macroeconomics and monetary policy classes that I took at San Francisco State to get my master's degree in economics, and I said I figured it out. Okay. I now figured it out. So here's the equation. Real gross domestic product, growth rates, real GDP, times the inflation rate is equal to or is related to the velocity of money. And the velocity of money is the number of times currency circulates in the economy per year. Okay, per year. So it's the velocity of money times the money supply growth rate. Okay, so this is the identity right there. So I was going, okay, well, GDP has been underperforming and inflation's been underperforming, so it's got to be one of these two, right? Process of elimination. But I know that the Fed has been growing the money supply at a very rapid rate, so I know the problem's in velocity. What is velocity? What drives it? So that was it. That was the solution. So let's go through, what?
Velocity would be like
The number of time currency
when it gets exchanged.
circulates in the economy. So let's say there's $30 trillion in the economy. 30 trillion turns over 6 times in the economy. So currency circulates 6 times per year within the economy. That's M1, M1 or M2.
So the problem was people are holding on to their money too long, or not?
That's good. Yeah, part of it was hoarding.
Yeah.
Because imagine,
Good
you
point.
went through one of the worst recessions ever. Where are you going to put your money? And prices are falling.
Not in the bank.
You're not putting it in the bank. You're putting it in a mattress,
You know that, yeah.
you know, or currency or something like that, because you need that liquidity. Because it basically took me 2 years to find a job, or 4 years to find a job. So I'm going to need that liquidity to basically get by for 2 to 4 years as precautionary balances. So I'm going to hold a lot of cash.
One more quick question.
Yep.
If you take, so say you had $5 million of velocity money to turn over.
It's the
Instead-
average is the velocity of money
Yeah.
peaked out at 9 and is now at around 6.
But say
It's
you
dropped
if
significantly.
you turn that into like a hard value asset like gold, is that still a turnover, or is that only a
No, it's
one-time
currency.
turnover?
Not, gold is not included in here. It's just currency, just dollars and coins. Okay. So let's dissect this. Okay, this equation, because it gives you the answer. Okay, and this is how the Fed thinks. Okay, and this is how senior executives think about this too. So the Fed basically has targeted the economy to grow at 3%. Okay, so if I go and I look at gross domestic product on a quarterly basis, it's calculated on an annual basis, and I go back 80 years and I calculate the average comes out to 3%. So the long run potential growth rate for the economy is 3%. Okay, and that's what the Fed is targeting, a 3% real GDP growth rate. Okay. Now from the forecast for 2019 and 20 is 2%. Is that 3%? Is it higher or lower? lower. So if the economy is growing below its potential, what's that gonna do to inflation or price pressure? Price is gonna be going down, or are they gonna be going up? If the economy is growing at 4 to 5%, is there more or less demand?
More demand.
More demand, what's that gonna do to prices? Drive it up, okay? And if the economy is growing below its long-run potential, what's that gonna do to prices? It's gonna cause them to go down or decelerate. So you're looking at disinflation, okay, or deflation. From 2010 to 2019, the GDP growth rate annually was 1.7%. Did they hit the target at 3? No. So they haven't hit the target over the last 10 years. In the first quarter of 2019, GDP grew at 3%. Did they hit the target? Yes. In 2018, real GDP grew at 3%. Did they hit the target? Yes. So just recently they hit the target, but over the last 10 years they haven't hit the target. And they're forecasting GDP to grow at 2% over the next 2 years. Okay. That's why Trump wants the Fed to lower interest rates to stimulate the economy as soon as possible, because it could be disinflationary, and if gross domestic product is decelerating, it's easy to move into a recession. And do you think he wants a recession before the 2020 election? No, he'll lose the Senate and he'll lose the presidency. Okay, so that's what's going on here. Did you have a question?
When it gets to 3%, like in 2019, when GDP is 3%, does that mean that it's equilibrium?
Yeah, the economy is growing at potential, and it's not creating any kind of inflationary pressure, because there's enough slack in the economy to absorb, there's enough demand to absorb all the supply and prices stay in equilibrium, where the inflation rate is trending at a very low rate. Okay, does that answer your question? Okay. The Fed was also targeting inflation, also core inflation. So basically core inflation is, commodities excluding energy and food, which are highly volatile. I think they should include it, but they don't include it. They strip it out, those volatile components, and they target the core inflation at 2%. So from 2010 to 2019, over the last 10 years, core inflation has been running at about 1.5%. So have they hit their target? No. And then first quarter 2019, the inflation rate's running around 1.2, and actually the last month, the CPI actually was negative. Okay. So is the Fed hitting its target?
So wait, I'm confused, they want more inflation or
Yeah.
less? But I
Yeah,
thought-
because the capitalist system in the United States and in the world, the banking system and the corporate, multinational corporate capitalist system runs on inflation. Okay, and if you have disinflation or deflation, the system kind of collapses on itself. It's not used to it. It's used to a moderate, targeted rate of inflation. I think it's pretty crazy to be targeting inflation,
Yeah,
because if the Fed's targeting inflation at 2% and your wages are not increasing by 2%, your standard of living and your real purchasing power is being eroded away. So in an inflationary environment, it's everybody at the bottom 50th percentile that's getting completely hosed.
so what would collapse if you had deflation? Why would that not be a benefit to have it?
Deflation is falling asset prices, such as real estate prices and stock prices. Okay, so imagine you're a bank
Yeah,
that has real estate assets collateralized by mortgages on the asset side of the balance sheet, and those assets are being written down, and the assets of the bank are being written down. It's gonna wipe out the owner's equity, and it's gonna create insolvency in the banking system. So the Fed tries to create a certain level of inflation, and it creates a certain level of profit margin maintained by companies who sell their goods and services in a moderate inflationary environment, gives them price pressure to then lock in their profit margin. Okay, so it's kind of a rigged system, but it's the way the system works. We're in a capitalist system. So has the Fed hit its targets? It just recently did, but over the last 10 years and prior to the most recent period, they didn't hit their targets. So they haven't hit GDP and they haven't hit inflation. So the question is, what's going on? So if you go over here, and you look at the velocity of money, let's hold the velocity of money constant, okay? And let's hold inflation constant. So if the Fed wants to increase real GDP, they would print more money and increase the growth rate in the money supply, okay? If you hold the GDP constant and you want to reinflate the economy, then the Federal Reserve needs to print more money. Holding velocity and GDP constant will cause the inflation rate to go up, okay? But the problem is that GDP and inflation have completely underperformed over the last 10 years, so the question is why? It's not growth rate in the money supply, because the Fed was growing the money supply at 30 to 40% in the deepest part of the recession. So the answer to the underperformance is in the collapse in the velocity of money. The velocity of money has collapsed to its lowest level ever on a global and domestic basis. Yes.
But how is like GDP in 2019 3%, and then like CPI being negative for this year?
It just, in the last month, CPI turned negative.
So how is the GDP in the last year?
Pardon? This is real GDP, this doesn't include inflation. It rips out, it's if you add these two together, that's nominal GDP. This is real GDP, okay? Any other questions? Okay, so the problem is in the velocity of money, it's collapsed. The Federal Reserve cannot control the velocity of money. There's no policies focused on increasing the velocity of money. So I did some research and I found out that the number one factor driving the velocity of money that's pro-cyclical, that's actually positively correlated with it, is employment. Employment. So as people make more money because they're because they're getting wages, they're going to save more, and they're going to consume more. And as they consume more, then it's going to be more transactions, and the velocity of money is going to increase. Okay? But the velocity of money has collapsed on a global basis. So the question is why? Why is the velocity of money collapsed? Well, there's a bunch of reasons. The main reason is there's a high degree of underemployment. The unemployment rate is what right now? The stated rate, the face rate. The headline unemployment rate is what? Is what?
3.7.
What? Yeah, it's 3.7. Got it. Is that low? Yeah. And the Fed's been targeting a natural rate of unemployment of 5%. So it's significantly below the target rate. Okay. But the problem is that the unemployment rate is a flawed number. Because after 2-3 weeks or 4 weeks, when your unemployment benefits, burn off, and you still haven't found a job, you're not counted in the numerator. You're not counted as unemployed. You're just something else. So actually, as people roll off the unemployment rolls, it actually shrinks the numerator and pushes down the unemployment rate artificially. But if you look at the underemployment rate, and this actually answers this question here, and it answers this question here. The unemployment rate is actually 3 times the stated unemployment rate. So the underemployment rate is running at around 12%. Okay. Now what's underemployment? I'm underemployed, right? I could be doing my skill sets are probably more honed to being in private equity or investment banking or real estate research or doing something else. So I'm basically underpaid based on my skill set, so I'm underemployed. The PhDs, in biophysics, from foreign countries or here in the United States that can't get jobs in the sciences have to drive around taxis, okay, to get employed. Those people are underemployed. Okay. So with an underemployment rate that's this high, you can see that people aren't consuming, right? So the velocity of money's collapsed. Inflation's low and GDP is not growing at its long-term potential. The other metric that kind of shows this is labor participation rates. These are people who actually are, in the prime working age as a percentage of the total population. the percentage of people who actually participate in the labor force is at the lowest it's ever been, going back to the 1970s. Okay? And the participation rate is at 63%, it peaked at 73% in like the 70s and 80s. So there's a huge reserve pool of labor that's basically sitting idle and is not participating in the economy. And if you just look around you, you can see that, college graduates, or not college, but high school graduates, people between the ages of 15 and 25 have very high unemployment rates and lower labor participation rates. And then males, particularly white males, African American and Hispanic males, between the ages of 45 and 65, a lot of them are out of the workforce totally. They just can't get any jobs.
Hired or not hired?
They're not even participating in the labor force. And if you're African American and Hispanic, the odds that you're going to be incarcerated are pretty high. So there's a whole reserve pool of labor incarcerated in the criminal justice system. And then white males between 45 and 65 that went through the financial crisis can't get jobs because they're now 65. And their skill sets and there's age discrimination. So they're out totally of the labor force. So it totally explains why the Fed hasn't been able to hit its GDP or its inflation targets, because you have a huge reserve of underemployed people and people who aren't even participating in the labor force. And employment is the #1 factor that drives velocity up and down. What's the other reason why velocity collapsed? Technology. The Federal Reserve can print trillions of dollars. I can borrow it as a hedge fund, and I can basically take that money and wire it over high-speed telecommunications lines to Brazil, Argentina, South Africa, wherever I want, and the money doesn't stay in the economy here in the US. It leaks out into the global economy and has no impact on the economy. Also, labor productivity. During the financial crisis, there was a major substitution between labor and technology. And now with AI, artificial intelligence, and machine learning, basically I can borrow $200,000, get a machine, an AI, artificial intelligence, machine learning machine, and I can replace your job for a piece of equipment and depreciate it and finance it with very low interest rates using bonds. So there was a major substitution effect between labor and capital, and then the other was the shadow banking system. There's now offshore money pools that are sloshing around capital that's not even being monitored by the Federal Reserve. It's basically a banking system outside of the banking system.
How are those legal?
Legal, because the Congress passed it in, formulated policies to allow this to be able to happen, and then the president signed it into law. Because Wall Street has direct input into the policy process in Washington. Wall Street basically owns Washington.
For unemployment, that you consider actively searching.
Yeah, exactly. Exactly.
For labor participation,
Yeah.
is that people they don't even work?
These are the people who actually participate in the labor force
Right.
in their prime working age, and then people who aren't participating
Right,
in it are not even they're on basically food stamps.
okay,
They're
like they have
getting-
no job, yeah.
They got no job and they're basically on the welfare system for now, until they cut all of that stuff. But this is a key metric right here. And this is this measure right here. So yes, the Fed did exceed the target using the base rate or the headline unemployment rate, but if you dig down into the unemployment numbers and really look at underemployment and labor participation, you can see that there's massive labor market failure, which has caused the velocity of money to collapse and caused the Fed to not be able to hit its inflation or its GDP targets. So basically making monetary policy ineffective. Okay? So that's basically the answer to that question. That's a long answer to a very short question. So then the answer is, if we were to fall into a recession, would the Fed use negative interest rate policy? The answer is yes. Okay? The Jerome Powell's looked at it. Janet Yellen actually made the banks stress test their balance sheets on their negative interest rate policy. Donald Trump this last weekend,
Yeah.
basically tweeted to Jerome Powell and the bozos at the Federal Reserve that they should basically be printing money, buying bonds, driving interest rates negative, like our brethren a European central bank out of Europe. Okay. So the question then becomes, what would be the impact on the economy if interest rates were to be driven negative? Well, if interest rates go down, what happens to your mortgage interest? Goes down. What about your car loan interest? Goes down. What about your student loan interest?
Yeah.
Goes down. Okay, so it's going to pull down the cost of capital. All right, but are you going to borrow if you know that you're going into a recession and you're going to lose your job? No. So at some point in time, lowering interest rates to negative or zero may have a short-term impact, but in the medium term, as the interest rates go to zero, you fall into what is Keynes called a liquidity trap. So you can drive interest rates to zero or negative, but you're not going to borrow because you're not going to have a job maybe in the next 6 to 9 months.
And then they BK on their loans, right?
Huh?
And then they BK on the loans.
Yeah, then
and
they'll
send something
probably,
to
if you
government.
default on your loans, then they're going to take your car, house, or whatever it is. So you're probably not going to, at some point, negative interest rates do have an impact on the economy in the short run to stimulate it, but over the long run, that effect, that stimulative effect will wear out. Okay. What about asset prices? Okay. So what I did was I used an example over here that will argue the negative interest rate. What happens? So, risk-free rates, negative interest rates on US government bonds. US government bonds are considered risk-free. So that's the risk-free interest rate on government bonds. If I was going to come up with a expected return on equity, I'm buying a stock, I want to get a 20% return, that's my expected return. So that's going to be my discount rate that I'm going to use in this valuation model. I'll show you in a second. Okay. So I need to come up with what my expected return is as an investor, and the company needs to come up with what the expected cost of the equity, the cost of the capital, is going to be. In both of those situations, same model, okay, that determines the expected return on the equity, the cost of the equity, and what is also called the discount rate. Okay. Now the discount rate, when you're talking about valuing stock, or the cost of the equity, or the expected return on the equity, you use an equation that is called the capital asset pricing model. You need to write that down. The capital asset pricing model, or CAPM. Now, the capital asset pricing model is equal to the risk-free rate plus what is called the beta. So if I have a stock, I look at Apple stock returns over time, and I got the returns on the S&P 500, and I run a regression, and I calculate the beta coefficient, that's the beta. Okay, so that's what this is right here. And betas go like this. Let's say I have the S&P 500, I got Apple stock, the returns move together, so my beta is 1. If the Apple stock moves more than the market, then my beta could be as high as 2. If the return on the market and the stock don't move together, let's say my stock returns don't move with the market, then my beta is going to be 0. And if the return on the stock moves less than the market, my beta is probably going to be, what, 0.65. So this beta measures the systematic risk, okay? Measures systematic risk. Why do you care about this stuff? Because the Federal Reserve sends interest rates negative, the risk-free rate is going to go negative. It's going to pull down this discount rate right here and cause the values to go up. So here, this could be earnings per share, it's the numerator, divided by your expected return, minus the growth rate in the cash flows. This is called the Gordon growth model. Okay? Next year's earnings per share, divided by the expected return, calculated by CAPM, minus the growth rate in the cash flows forever. So all of a sudden, the Fed cranks up the printing machine, starts buying government bonds, drives up bond prices, drives down interest rates, drives them negative. Okay? So that negative interest rate is going to pull down your expected return, and it's going to cause, holding the growth rate constant, it's going to cause the value of stocks to go up. That's what the Federal Reserve did. Here is they basically printed a ton of money, bought bonds, drove interest rates to zero, brought down this expected return and the cost of the equity, and inflated stock prices to the point now where the stock market is at the highest it's ever been in history. That's the answer right there, the effect on asset prices. So if the Federal Reserve decides to go back to zero interest rate policy and negative interest rate policy, it's going to cause the expected return to go down and asset prices to be inflated. Stock prices have not gone up because of cash flows coming out of the corporation. Stock prices have gone up mainly because the Federal Reserve has manipulated interest rates, driven them to zero, and caused stock prices to go into bubble territory. So what happens if the Federal Reserve decides to not drive interest rates negative or zero?
Bubble pop.
The bubble pops. You got it. You got it. Yes.
So what would cause, like, today I noticed Apple's up 0.5%?
Yeah,
Dow
Apple's
Jones
just
is
one
down
stock.
0.5%.
Apple's just one stock.
Okay.
That's not the overall stock market. Based on the Standard & Poor's 500, the top 500 companies listed on the New York Stock Exchange. Which is, even though the majority of the S&P 500 index is made up of Apple, it's not, there's 499 other stocks that are in the index. Okay? All right, and what happens to, so asset prices, so if you're lucky enough to own stock, and we go to a negative interest rate policy, we'll probably benefit by inflated stock prices. So if you're one of the top 90th percentile or 70th percentile of the socioeconomic strata that actually owns stock, you benefited and you probably will benefit. But if you're at the bottom 75th percentile and you don't own inflatable assets or inflated assets, you're going to be hurt, right? I mean, the United States right now is the only industrialized country that basically has the most severe inequality of any other industrialized economy. And the zero interest rate policy that occurred over the last 10 years basically exacerbated the wealth distribution and basically redistributed the majority of the wealth to the top 90th percentile. Am I just boring? Is this boring? No, this is the truth, okay? What happens when interest rates, what happens if negative interest rates, what is the effect on savers if we have negative interest rate policy? You're gonna retire in 10 years. You're gonna invest in bonds. Over the next 10 years, if interest rates are negative, you're gonna be buying negative interest rate bonds. If you're not holding bonds already, but you're buying negative interest rate bonds, you're basically getting less, you're actually paying a tax. So you're getting hosed. Your standard of living is basically deteriorating by the purchase of negative interest rate bonds. That's basically what's going on. Right now on a global basis is people are complaining, investors are complaining, savers are complaining because they've been buying negative interest rate bonds, having to save more for retirement because the amount of money that they're gonna get when the bonds mature is less than what they paid for it. So they're getting liquidity, but they're not getting any kind of wealth accumulation. It's actually worse off.
So what is the benefit of buying negative interest rate?
Because it props up asset prices.
So now if that interest rate goes to the positive, then that's.
That means that me as a saver, I'm buying positive interest rate yielding bonds. I'm gonna get a coupon payment, I'm gonna get a principal amount at the end. I can use those coupon payments to buy Tony, you know, my dog, you know, some dog food, you know, or I can use it to buy gas or to buy food or something. If I get negative interest rates, I'm not getting any money,
Right.
right? I'm getting negative yielding. So you're worse off, your standards of living are actually falling.
So it's,
Savers are completely hurt in that
so do
situation.
people still buy those bonds right now?
Yeah, for liquidity purposes, and plus, if I'm in the United States, how easy is it for me to go buy a positive yielding Italian bond? Is it easy?
Probably not.
No, no, and you're almost trapped, you really can't convert your dollars to euros to buy Italian bonds, that there's transaction costs. It's hard to do, I gotta find a dealer that's gonna find me Italian bonds. So basically, domestic savers are almost forced into buying negative yielding government bonds. Yeah, it totally sucks. It's a problem. Okay, and people are getting really upset because they've been buying these negative yielding government bonds for the last 10 years. In Japan, in Switzerland, in Europe, in Denmark, and a lot of these countries. How would investors fare? If I'm a real estate investor, this is my net operating income. And interest rates start to fall, and my cost of capital goes down, what happens to the value of my real estate?
Why?
So if my cost of capital goes down and my interest rates go down, my mortgage interest rates go down, what happens to the value of my real estate? Goes up. Negative interest rates pull down the expected returns on stocks, what happens to stock prices? They go up. And if interest rates go down, what happens to bond prices? They go up. So if I'm an investor, don't I benefit?
Yes.
Yeah, in the short run, I'm gonna benefit, right? What about businesses? If interest rates go negative or go really low, and it pulls down their cost of capital, that means that they can borrow and they can invest, they can expand, they can generate revenues in the short run. But in the long run, eventually, the feedback loop from negative interest rates is gonna flow through the economy. People aren't gonna have a lot of income from their investments to basically use to consume. And that's gonna cause the economy to underperform in the long run. So negative interest rate policy is really important. How much time do I have?
10 minutes?
10, okay. The next question is the yield curves. Okay, is yield curves. Now the syllabus, right, assumes you know all this stuff, right? Because you're taking macroeconomics. Right? So you know all this stuff, yield curves, monetary policy, QTM, and all that stuff, right? That's what they assume that you know. I assume you don't know, okay? I'm gonna teach you. Okay? And this is what everybody's talking about, right? So this is the yield curve, okay? This is the maturity of the bonds, okay? Maturity, 3 months, 6 months, 9 months, 1 year, 3 years, 5 years, 7 years, 10 years, 30 years, and now Mnuchin wants to do 50-year government bonds. For each maturity, there is an associated interest rate, okay? The yield curve, when it's normal, is upward sloping. It looks like this, okay? This is an upward sloping yield curve. That's the way the curve should look. So the further out you go in maturity, the higher the interest rate. Okay? The yield curve assumes that each one of these interest rates, these are considered nominal interest rates. Okay? Irving Fisher, the Fisher equation states that nominal interest rates equals the real rate plus inflation expectations. Now the real rates move cyclically and secularly. They do not move on a daily basis. So they're basically a constant. So movements in the yield curve, either shifting up or shifting down or flattening or inverting, is driven by inflation expectations. You might want to take a picture of this. So movements in inflation expectations drive interest rates up and down and causes the yield curve to shift up and down, and causes it to flatten and causes it to invert. Why is this important? Because the yield curve inverted like 2 months ago. It's been inverted, depending on your measures, for over a year and a half. Why is that important? Because when the yield curve inverts, the stock market peaks in less than 12 months and you're in a recession in less than 24. And I've been talking about this for 5 to 7 years in all my classes, and the yield curve finally inverted for the first time since 2007. Okay. That's why we're talking about it.
Is there a way for it to flip back?
Huh?
Is there a way for it to flip back without going into a recession?
Yeah. I'll explain that. Okay. So it's an upward sloping curve. So if inflation expectations go up, the yield curve could shift up. Okay. If inflation expectations shift down, then the yield curve can shift down. Okay. So the yield curve can shift up and down. Okay. But the key to this whole thing, this is what's really important, is that what's happened, because the economy has been relatively strong recently, that the Federal Reserve have been raising short-term interest rates to cool the economy, to keep it from overheating, and keeping the stock market and the bond market and the real estate market from reaching bubble territory. So as they were raising interest rates, the yield curve started to flatten out. But then the Federal Reserve continued to sell bonds and actually inverted the curve, because they were selling so many bonds and it drove bond prices down further, drove interest rates in the short run up even higher. And when you see an inverted curve, people say we're going into a recession. So they ended up buying more bonds out here, driving up bond prices and driving down interest rates even lower on the long end. So inverting the curve. Since the first time since 2007. Now when the curve inverts, the stock market peaks in less than 12 months, and you're in a recession in less than 24. That's the other question on the exam, okay? Which is the one on page 2. Okay. That's the answer I'm looking for on page 2. So the question here is, using the Fisher equation, what variables drive risk-free rates, nominal interest rates on treasuries by maturity up and down inflation expectations? What shifts the yield curve up and down and flattens and inverts it? Inflation expectations, both in the short run, medium term, and in the long run. Show the equation. Right here. Does a very good job. There's your equation. There's your interest rates. There's nominal. So basically, if inflation goes up, nominal interest rates go up. Inflation expectations go down, nominal interest rates go down. Inflation expectations go up, nominal interest rates go up. Inflation expectations go down, nominal interest rates go down. You need to memorize that. Show the equation graphical representation of the normal upward sloping curve. Got it. Flat curve. Got it. And an inverted curve. Got it. What impact do movements and shifts in the yield curve have on asset prices? Well, we did it over here. So if the Fed sells off the bonds and drives up interest rates, over here, if interest rates go up and your expected return goes up, then stock prices and real estate values and bond prices are going to go down. If the Federal Reserve buys the bonds, drives up bond prices and drives down interest rates, if interest rates go down, then the expected returns go down and asset prices go up. Okay. How does the Federal Reserve influence interest rates? Through open market operations. Okay. The Federal Reserve owns basically an inventory of Treasury securities. And if they see that the economy is overheating, they're going to start selling off the bonds, driving down bond prices, driving up interest rates to cool the economy. They think the economy is going into a recession. They're basically going to print money, buy bonds, drive up bond prices, drive down interest rates to stimulate the economy. Okay. So basically, the Federal Reserve uses open market operations to stimulate or cool the economy. If the Fed buys and sells bonds, what is the impact on bond prices? Well, if they buy bonds, bond prices go up and interest rates go down. If they sell bonds, bond prices go down and interest rates go up. Does the Does the Fed control and influence directly short-term or long-term interest rates or both? The Federal Reserve directly controls short-term interest rates. It indirectly influences medium and long-term interest rates. Okay, and then I think there was another one here on the, was there yield curve theories? Wasn't there a, there's 3 theories for the yield curve. Or actually, there's 4 theories. That gives you an indication of why a yield curve shift up and down and flatten and invert. How am I doing on time? Is it time? Okay. I'll take a picture of this and I'll do the theories. So if you understand yield curve and yield curve dynamics and orthodox monetary policy, you'll be able to understand it. I already answered page number 2, the dynamic yield curve. Yeah.
Like taking pictures and